The theme in recent quarters has been mixed signals, and the second quarter continued to that trend. In the news, regional bank concerns remained, but appear to be contained for now, while the debt ceiling deal in May removed one of the year's greatest concerns. In the economic data, inflation, while cooling, is still higher than expected, leading the Fed to signal one or two additional rate hikes before this cycle peaks. Meanwhile, spending and employment remain strong, but consumer sentiment is poor. In theory, people should be happier about current economic conditions, but they're not. In the bigger picture, changes resulting from the pandemic, such as a sharp increase in the amount of hybrid or fully remote work, has affected our daily lives and the economy. And as a result, historical context has been much less useful for the markets and the economy. This makes forecasting even more difficult than it normally is. All this has led to some interesting times for financial markets. Let's start with a look at U.S. equities. U.S. equities rallied 8.7% on the quarter and are now up by 17% on the year. Taking a deeper look, we have very narrow leadership in U.S. stocks, with 7 stocks producing the majority of the broad index gains. Most of these names are large technology firms that will benefit from the rapid adoption of artificial intelligence or AI. By now, you've probably heard about all the AI buzz. Maybe you're like me and started to play around with ChatGPT. Maybe you're excited about the potential for self-driving cars. Whatever the use case, the market also appears to be very excited about AI, and for good reason. Looking at historical tech adoption and the race to 1 million users, for Facebook it took 10 months, Spotify took 5 months, and ChatGPT took just 8 days. While there's a lot of hype around AI, it's hard to argue with numbers like this. I will discuss more about AI and its impact later in the webinar with Dave. It's also worth noting that in the US, the dominance of growth stocks over value stocks in 2023. Zooming out a bit, the Russell 1000 Growth Index has risen by 29% in 2023, significantly outpacing the Russell 1000 Value Index at 5%. This is notable because growth stocks historically benefit from a lower rate environment. But we haven't had a lower rate environment, so past norms are not reflected by today in stock performance. Let's look now closer at international stocks. International equities were slightly behind US stocks, with the MSCI EAFE index up 3% in Q2 and the MSCI Emerging Markets Index up 1.6%. Specific international indexes are very mixed, with positive examples like Japan, with the stock market at a 33-year high. They're benefiting from ultra-loose monetary policy. Or Mexico, which is up 25% year to date, buoyed by the potential for expanded trade with the US amid the themes of companies reshoring manufacturing to this country. Compare that with China, down 7% in Q2 and 6% year to date as the economy remains soft despite reopening. Let's look now at a slide from our friends at JP Morgan that looks at both earnings trends and valuations at international companies. On the right, we can see valuations. International stocks remain cheap compared to the US when looking at the price to earnings ratio. Europe is at 12.5 times earnings, while emerging markets are about the same, and China is even lower at 10 times earnings. All of these look attractive compared to US stocks at 19 times. On the left, we see the growth of earnings. In the era since the Great Financial Crisis, we've had loose monetary policy and low inflation, with the US and its exposure to growth companies as the main beneficiary. Now that the easy money era is over, we should see a return to more even levels of earnings growth, which is supportive of international markets. You can see that to the left of the gray bar, which was the GFC. Before we talk about bond returns, let's look at the US yield curve. The green line is 1 year ago, when we had lower and a normal curve, with yields lower in short dates and higher in longer maturities. The blue line is 3 months ago, the end of Q1 that reflects a sharply higher yield curve, especially at the front end after 5% of rate hikes from the Fed. Looking at the yellow line, that's the end of Q2, showing that yields have pushed higher as inflation remains sticky and as Fed officials continue to manage expectations for higher rates for longer than previously priced in. Now let's look at bond performance. With the uptick in yields, the U.S. bond market was lower by about 1% on the quarter. For the year, bonds are up about 2%, more in line with historical returns after a difficult 2022. Meanwhile, commodities have fallen so far this year as inflation cools. The Bloomberg Commodity Index was down by 3% on the quarter, driven by a 3.5% decline in oil, and has continued to decline since peaking with a 26% return in Q1 of 2022. Our colleague Andrew Steedman recently wrote about what caused the commodity spike last year and why the asset class is down in 2023. Check out his blog on our website. On a final note, this historical chart is returns of a 60-40 portfolio. Without digging too deep, the longer-term perspective reminds us that in years following a sharp move lower in a balanced portfolio, returns in subsequent years tend to be positive. So while signals are mixed, and as we continue to adjust to whatever this new normal is going to be, it should not really be surprising to have positive markets this year.